On the morning of October 29, 1929, 11 men, prominent Wall Street bankers and brokers, were confirmed to have taken their own lives before noon. By the end of that single week, more paper wealth had evaporated than the entire cost of the First World War, and yet almost no one saw it coming, not the banks, not the government, not the most respected economists of the age. The morning arrives the way October mornings do in New York, not gently, but with a kind of cool insistence, a sharpness in the air that presses itself against the skin and refuses to be ignored. It is not yet 7 o'clock. Somewhere below the window of a boarding house on West 48th Street, a milk truck is making its rounds, the glass bottles chiming softly against one another in their metal crates. A sound so ordinary it belongs to another world entirely, a world that existed yesterday, and perhaps not today. A man sits on the edge of a narrow bed. He's not young, but he is not old. He is the age of a man who has spent the last 4 years believing in something completely. On the small writing desk beside him, a neat column of figures is penciled into a ledger. Careful, methodical, the handwriting of someone who understood numbers to be reliable things. Beside the ledger, a telephone. Beside the telephone, nothing. He knows, already, before he has heard a single word from the street, that the numbers in his ledger no longer correspond to anything real. Outside, the city is waking into the strangest day it has ever known. The world before the fall. To understand what happened on October 29th, 1929, you must first understand what it felt like to be alive in America in the years that led there, because the crash did not arrive from nowhere. It arrived from somewhere very specific, from a decade of abundance so vivid, so relentless, and so genuinely unprecedented that it had begun to feel, to millions of ordinary people, like the permanent condition of the modern world. The 1920s were not merely prosperous, they were intoxicating in a way that prosperity rarely manages to be, because this prosperity came dressed in the costume of the future. Automobiles were no longer novelties, they were necessities, rolling off the assembly lines of Detroit in numbers that would have seemed fantastical a generation before. The radio had transformed silence into a shared experience. The cinema had made fantasy democratic. For the first time in American history, ordinary working families, clerks and school teachers and factory supervisors, could participate in a culture of leisure that had previously belonged only to the wealthy. And underneath all of this, running like a warm current through the decade, was the stock market. You find yourself, for a moment, imagining what it would have meant to live inside that world. Not as one of the great industrialists or the storied banking families of the Eastern Seaboard, but as someone ordinary, a bookkeeper in Cincinnati perhaps, or a haberdasher's assistant in Chicago. You have read the newspapers, you have heard the stories. Your neighbour, a man who installs electrical fixtures for a living, has made more money in the past 18 months through his brokerage account than he has made in 3 years of wiring houses. He does not speak of it loudly, but he does speak of it. And so, you listen. The market, by the late 1920s, had ceased to feel like a specialist instrument. It had become something closer to a national religion, one with its own theology, its own prophets, its own promises of salvation. The Dow Jones Industrial Average, which had stood at roughly 63 points in August of 1921, climbed to a peak of 381 points in September of 1929. That's a gain of more than 500% in 8 years. For those who had been positioned inside that rise, who had bought shares in Radio Corporation of America, in General Motors, in the great utilities conglomerates that were being assembled like architectural wonders across the American landscape, the returns were not merely comfortable, they were transformative, life-altering, and this in the end is what made the crash so devastating, not merely the scale of the financial loss, but the scale of the dream that preceded it. Settle into this moment. The world of 1929 is one you need to hold in your hands for a while before we watch it come apart. There is a particular quality to the light inside the New York Stock Exchange on a busy morning in the middle years of the 1920s, a quality that photographers and journalists of the period tried repeatedly to capture, and never quite managed to render accurately on the page. It is not simply brightness, though the trading floor is bright enough lit by the great arched windows that face Broad Street, and by the overhead fixtures that were installed as the exchange expanded to accommodate the decade's escalating volume. It is something closer to electricity, in the literal sense. A a charge in the air produced by hundreds of human bodies moving with purpose, shouting with purpose, existing with a focused intensity that has no real analogue in the ordinary world of offices and storefronts and quiet residential streets. The floor of the exchange is not a peaceful place. It has never been a peaceful place. But in the years between 1924 and 1929, it achieves a particular kind of magnificent disorder. The disorder of a machine operating beyond its designed parameters, pushed harder and faster than its engineers ever intended, and somehow, miraculously, still holding together. You would hear it before you saw it if you were standing in the lobby of the building on Broad Street. A sound like surf. Rhythmic at first, then not. A tide of human voices rising and falling with the arrival of new information, new orders, new numbers streaming in from the telegraph wires that connected this room to the rest of the world. The sound carries a specific emotional frequency. Not panic, not quite joy, but something between them. The sound of people operating at the edge of what they can contain. This is the world that the American investor of the 1920s came to understand as normal, and the mechanism that made it possible, that transformed the New York Stock Exchange from a marketplace for the moderately affluent into something closer to a national institution, open to almost anyone who could find a few $100s and a willing broker, was one of the most seductive and ultimately destructive financial inventions ever to gain widespread adoption in a modern economy. It was called buying on margin. The concept is not complicated, and this is part of what made it so dangerous. To buy on margin meant to purchase stock using borrowed money, to put up only a portion of a share's price yourself, and borrow the remainder from your broker, with the shares themselves serving as collateral. In the mid-1920s, margin requirements on Wall Street were almost entirely unregulated. Some brokerage firms required a buyer to put up as little as 10% of a stock's purchase price. This meant that with $100 of your own money, you could control $1,000 worth of stock. Sit with that for a moment, because the mathematics are worth understanding slowly. If you buy $1,000 of stock with $100 of your own money, and that stock rises by 10%, an increase of $100, you have doubled your investment. Your $100 has become $200. The broker is repaid his $900, plus interest and fees, and you walk away with a profit equal to your entire original stake, achieved in what might have been a matter of weeks or months. This was the arithmetic that lit the decade on fire, because of course the inverse was equally true, and the inverse would eventually become the central mechanism of the crash. If that same $1,000 of stock fell by 10%, your $100 stake was entirely wiped out. The broker, whose loan was now inadequately secured, would issue what was called a margin call, a demand for additional funds to restore the required ratio of equity to borrowed capital. If you could not produce those funds, the broker would sell your shares immediately, at whatever price the market would bear, to recover his money. You would be left with nothing, and potentially with debts. But in the years of the bull market, this shadow arithmetic was easy to ignore. The market was rising. It had been rising for years. The gains were real, the losses theoretical, and the human mind, particularly the human mind in the grip of collective optimism, has a remarkable capacity for treating theoretical losses as someone else's problem. By 1929, it was estimated that the total amount of money borrowed on margin in the American stock market had reached approximately $8.5 billion. To give that figure some texture, the entire annual output of the federal government at the time was roughly $3 billion. The borrowed money floating underneath the American stock market was nearly 3 times the size of the national budget. And much of this borrowed money belonged not to wealthy speculators with diversified portfolios and ample reserves, but to ordinary Americans who had entered the market for the first time, people for whom a margin call would not mean inconvenience but ruin. The brokers who extended this credit understood the risk in the abstract. But the business of a brokerage firm in a bull market is the volume of trades, the commissions earned on each transaction, the interest collected on margin loans. The incentive structure of the industry pointed uniformly in one direction: more accounts, more trading, more credit extended. The warnings, and there were warnings, as we will come to see, tended to be heard by those who issued them and few others. This is not to say that the men who ran the great brokerage houses of Wall Street were villains in the simple literary sense. Most of them were not. They were, in the main, men who had built their careers during a period of genuine and substantial economic growth, who had watched the American economy expand at rates that had no historical precedent, and who had arrived at the reasonable but ultimately catastrophic conclusion that what had been true for the past decade would continue to be true for the decades ahead. The market had always recovered. The economy had always expanded. The occasional sharp declines that punctuated the general upward trend had always, in time, reversed themselves. To these men, sitting in their panelled offices overlooking the canyons of Lower Manhattan, caution was not wisdom. It was timidity. And timidity, in a rising market, was simply money left on the table. It is worth pausing here, in the middle of all this mechanical explanation, to ask a quieter question. What did it feel like, in the body, to be someone who had watched their brokerage account double in 18 months? There is a quality to unexpected financial gain that is difficult to describe to someone who has not experienced it. A particular warmth, a loosening of something that had been held tight without your full awareness. The future, which had always carried a faint edge of uncertainty, suddenly seems malleable. The sense of permanent precariousness that underlies ordinary economic life, the awareness, always present at some level, that a single prolonged illness or a lost job could unravel years of careful saving, begins slowly to recede. You're not merely richer, you're safer. You have purchased, or so it feels, a small measure of immunity from the ordinary disasters of mortal existence. This feeling was not unique to the wealthy. It was, in the 1920s, available to almost anyone. And this democratization of financial optimism, this spreading of the warm, loosening sensation of paper prosperity across a population that had never had access to it before, was one of the most consequential social developments of the decade. It meant that when the crash came, it would not strike a narrow stratum of professional speculators who understood and had accepted the risks of the game. It would strike schoolteachers and shopkeepers and retired postal workers. It would strike people who had invested their life savings on the sincere belief, reinforced by everything they had read and heard and observed, that the market only went in one direction. There is something worth sitting with in that. Not judgment. These people were not foolish. They were rational, in the way that humans are rational. They looked at the evidence available to them. They spoke to people they trusted, and they made decisions that seemed, given what they could see, entirely reasonable. The tragedy is not that they were credulous. The tragedy is that the information available to them was systematically incomplete, that the architecture of the financial system in which they were participating concealed, behind its gleaming facade of rising numbers and confident pronouncements, a structure of compounding fragility that would not survive contact with a sustained decline. And what of the men at the very top of that architecture? What did they know, and when did they know it? The answer is more complicated than comfort would suggest. Some of the most prominent figures in American finance in the late 1920s were genuinely convinced that the prosperity of the decade was sustainable, not indefinitely perhaps, but for the foreseeable future. Irving Fisher, the Yale economist who was arguably the most respected economic thinker of his generation, declared in early October 1929 that stock prices had reached what looked like a permanently high plateau. He was not being dishonest. He believed it. The models he was using, the theories through which he interpreted the data available to him, led him sincerely to that conclusion. He would lose the equivalent of millions of dollars in the crash and spend the rest of his career attempting to explain what he had missed. Fisher's error is worth examining carefully, because it was not the error of a fool. It was the error of a brilliant man working within a framework that was, in certain critical respects, inadequate to the reality he was trying to describe. Fisher believed that the rising productivity of the American economy, the genuine efficiency gains produced by electrification, by the assembly line, by the rationalization of industrial processes, justified higher stock valuations than historical averages might suggest. He was not wrong about the productivity gains. He was wrong about the degree to which those gains had already been incorporated into, and indeed exceeded by, the prices the market was charging for access to them. The distinction between these two errors, being wrong about the direction of the economy versus being wrong about the relationship between economic direction and stock prices, is subtle but crucial. Stock prices are not simply a reflection of economic conditions. They are a reflection of economic conditions as filtered through the expectations, fears and enthusiasms of the people who are buying and selling them. a genuinely productive economy can still produce a genuinely overvalued stock market if the expectations embedded in prices have run ahead of even the most optimistic realistic scenario for the underlying businesses. This is what Fisher missed, and it is what millions of ordinary investors missed alongside him. Not because they were following him specifically, but because the culture of the late 1920s had produced a generalized version of his era. The conviction that the new economy of radio and automobiles and electrical appliances was so fundamentally different from what had come before, that the old rules about valuation simply did not apply. Others knew more than they said. The great banks, National City Bank under Charles Mitchell, Chase National under Albert Wiggin, were, by 1929, operating in ways that intertwined the fate of their own stock prices with the health of the broader market to an extent that made honest assessment of risk almost impossible. Mitchell, who was known as the most aggressive salesman in American banking, had spent the decade expanding National City's retail operations, transforming it from a wholesale institution into something approaching a modern mass-market bank, with branches across the country selling investment products to ordinary depositors. The growth of his empire depended on the continuation of bull market conditions. He had every incentive to believe, and every incentive to ensure that others believed, that those conditions would persist. In the final months before the crash, Mitchell became something very close to the public face of market optimism. When the Federal Reserve Board expressed concern about the level of speculation and discussed restricting the credit that banks were supplying to brokers for margin accounts, it was Mitchell who publicly defied the Fed's moral suasion, announcing in March 1929 that National City would lend an additional $25 million to the call money market, regardless of the Reserve Board's preferences. This act of defiance was widely applauded in the financial press as a demonstration of the banking establishment's confidence in the market's soundness. It was, in retrospect, a demonstration of something else entirely: the degree to which the financial system's major institutions had become structurally committed to the continuation of the bull market and were willing to use their enormous resources to maintain it. The electricity on the trading floor had a source, then, not merely the optimism of ordinary investors, but the active, sustained, and enormously profitable promotion of that optimism by the financial institutions that stood to benefit most from its continuation. This is the architecture beneath the architecture, the structure that supported the structure. And all of it, in the autumn of 1929, was about to discover its own weight. There is a phrase that appears repeatedly in the financial literature of the late 1920s, deployed with a frequency that, in retrospect, carries a particular chill. The phrase is investment trust, and in the years between 1926 and 1929, it came to represent one of the most elegant and ultimately catastrophic financial instruments that American ingenuity had yet devised. An investment trust, in its simplest form, was a company that existed primarily to hold shares in other companies. You, as an investor, would purchase shares in the trust, and the trust would use your money, pooled with the money of thousands of other investors, to purchase a diversified portfolio of stocks on your behalf. The appeal was obvious and genuine. Rather than trying to pick individual stocks yourself, with all the research and expertise that required, you could hand your money to a professional organization that presumably knew what it was doing and benefit from whatever gains the broader market produced. The concept was not new. British investment trusts had operated on similar principles since the 1860s and had, on the whole, served their investors reasonably well. But the American version of the investment trust, as it evolved through the fevered years of the late 1920s, bore only a superficial resemblance to its British predecessors. What American financial promoters had done was take the basic, sensible idea of pooled investment and layer upon it a degree of financial engineering that transformed it from a conservative vehicle for diversification into one of the most leveraged and volatile instruments in the history of American finance. The mechanism of this transformation was leverage. The same borrowed money arithmetic that governed margin buying applied now at the institutional level, and with consequences that compounded in ways that were genuinely difficult to trace. Consider what Goldman Sachs did in 1928 and 1929, because it illustrates the structure with particular clarity. The firm created an investment trust called the Goldman Sachs Trading Corporation, which sold shares to the public and used the proceeds to purchase a portfolio of stocks. So far, entirely conventional. But the Goldman Sachs Trading Corporation then created a second investment trust, the Shenandoah Corporation, whose assets consisted largely of shares in the Goldman Sachs Trading Corporation itself. And then Shenandoah, in turn, participated in the creation of a third trust, the Blue Ridge Corporation, whose assets consisted largely of shares in Shenandoah. What you had, in the end, was a tower of paper, each layer resting on the layer below it, each layer's value dependent on the value of the layer beneath, and all of it ultimately resting on the actual underlying stocks at the base. If those underlying stocks rose, the gains were magnified at each level of the structure, producing returns that seemed almost magical to investors in the upper tiers. If those underlying stocks fell, the losses were equally magnified, and they cascaded downward through the structure with a speed and force that no one at the top of the tower could easily anticipate or contain. By the summer of 1929, there were approximately 750 investment trusts operating in the United States, with a combined capitalization estimated at somewhere between $6 and $8 billion. New trusts were being launched at the rate of nearly one per business day. The financial press covered each new offering with the kind of enthusiasm ordinarily reserved for major scientific discoveries. Investors who had already made substantial gains in the market eagerly channeled those gains into trust shares, confident that the expertise of professional managers would continue to generate the returns they had come to expect. What did those professional managers actually know? This is a question worth holding gently, because the answer is both more and less reassuring than you might expect. Some of the men who ran the major investment trusts of the late 1920s were genuinely skilled analysts who believed sincerely in the fundamental value of the companies whose shares they held. Others were frankly promotional, more interested in the fees generated by launching and managing trusts than in the actual performance of the underlying portfolios. And some, operating in the grey zone between these two poles, had allowed the distinction between their own financial interests and the interests of their investors to become, over time, usefully blurry. The trust managers were compensated in many cases on the basis of the asset value of the trust, which meant that a rising market, regardless of whether that rise reflected genuine economic value or mere speculative enthusiasm, made them rich. There was no mechanism that rewarded caution, no structure that penalized the embrace of leverage, no institutional pressure that favored the honest assessment of downside risk. The incentives pointed, as they so often do in periods of financial excess, in precisely the wrong direction, and so the trusts accumulated leverage. They bought stocks on margin, they invested in other trusts which invested in other trusts. They constructed, with enormous skill and genuine ingenuity, an architecture that was spectacularly efficient at capturing gains, and equally spectacularly efficient at transmitting losses when the direction of the market reversed. There is a quieter story inside all of this that deserves attention, the story of what the ordinary purchaser of trust shares actually understood about what they were buying. The prospectuses for investment trusts in the late 1920s were, in many cases, masterpieces of selective disclosure. They described the professional management, the diversified portfolios, the impressive track records of the founding institutions. They were somewhat less forthcoming about the layers of leverage embedded in the structure, the conflicts of interest that arose when trust managers invested in companies with which they had pre-existing relationships, or the precise mechanisms by which losses in one tier of the structure would be transmitted to investors in other tiers. This was not, in most cases, illegal. The regulatory framework that would eventually require full disclosure of such information did not yet exist. The Securities Act of 1933 and the Investment Company Act of 1940, which would eventually bring investment trusts and their successors under meaningful regulatory oversight, were creatures of the Depression years, born directly from the catastrophic failure of the system they would come to govern. In 1928 there was no such framework. There was only the market, and the market in 1928 was going up. You find yourself, perhaps, thinking about the sheer human scale of what was being built during those years, not merely in dollars, though the dollars were staggering, but in the scope of participation. Ordinary families were reading the financial pages with the same attention they gave to sports results. Barbers and taxi drivers were offering stock tips to their customers. The vocabulary of Wall Street, bulls and bears, margins and dividends, yields and ratios, had leaked out of the financial district and into the ordinary language of everyday American life. A culture had formed around the market, and like all cultures, it had its own norms, its own stories about itself, its own ways of treating dissenters. The person who questioned whether stock prices might have risen beyond what the underlying businesses could justify was not merely being cautious. They were, in the social register of the late 1920s, being a killjoy, a coward, someone who lacked the vision to see that the old rules no longer applied, that a new era of permanent prosperity had genuinely arrived and was not going away. The castles were made of paper, and they were very beautiful, and for a very long time they did not fall. And somewhere, in a modest office on the 14th floor of a building on State Street in Boston, a statistician named Roger Babson was quietly doing arithmetic that suggested they were about to. If you're drifting now, let yourself go. Subscribe so the next story is waiting when you return. Sleep well. Roger Babson was not the kind of man who made a dramatic entrance. He was short, methodical, and prone to issuing his predictions in the measured cadences of someone accustomed to being dismissed. He had founded the Babson Statistical Organization in 1904 in Wellesley Hills, Massachusetts, and had spent the intervening decades building a reputation as an economist who concerned himself primarily with what the numbers actually said, rather than what people wished they said. On September 5th, 1929, Babson rose to speak at his annual National Business Conference. The market had been softening slightly for several weeks, not alarmingly, just enough to make the particularly attentive investor slightly uneasy. Babson was not particularly attentive in the financial press's sense of the word. He was attentive in a different sense entirely, attentive to long cycles, to the structural mathematics of markets, to the historical record of what happened when the distance between stock prices and underlying earnings stretched beyond a certain point. What he said that afternoon was not complicated. He said, in essence, that a crash was coming. He predicted that the Dow Jones Industrial Average would fall by 60 to 80 points, a substantial decline at a time when the index stood near its historic high. He pointed to the extraordinary levels of margin debt, the overvaluation of investment trust shares, the divergence between stock prices and the actual productive capacity of the businesses those prices were supposed to represent. The market's immediate response to Babson's remarks was a sharp decline of nearly 3%, enough to earn the event its historical name, the Babson Break. It was the kind of visceral, immediate reaction that might, in a more self-aware environment, have prompted serious reflection. Instead, it prompted a counter-response from the financial establishment that was swift, unified, and almost perfectly calibrated to reassure investors that nothing Babson had said required any alteration of their existing plans. Irving Fisher, the Yale economist, issued a rebuttal within days. The market's fundamentals were sound, Fisher argued. The companies whose shares were traded on the New York Stock Exchange were genuinely more productive, more efficient and more profitable than they had been a decade before. The rise in stock prices reflected real economic progress, not mere speculative froth. Babson was applying the arithmetic of previous eras to a new economy that had not yet been fully understood. Fisher's rebuttal was widely reprinted. Babson's original warning was widely mocked. The market recovered its losses from the Babson break within days and continued its ascent, and the episode was filed away, by those who bothered to file it at all, as evidence that the prophets of doom were, as usual, wrong. But Babson was not the only voice raising concerns in 1929, and the others deserved their moment in the chronicle as well, not because they were uniformly correct in their predictions, but because the pattern of their warnings and the pattern of the response to those warnings tells us something important about how financial catastrophe becomes possible in the first place. The Federal Reserve had in fact been attempting to cool the speculative fever for more than a year before the crash. Beginning in 1928, the Federal Reserve Board had raised interest rates repeatedly, hoping to make borrowed money more expensive and thus discourage the margin lending that was fueling the market's most excessive speculative activity. The rate increases were real and were felt in the economy. The cost of call money, the short-term loans that brokers used to fund margin accounts, rose substantially. Business investment outside the financial sector began quietly to slow. What the Federal Reserve had not anticipated, or had perhaps anticipated but felt unable to prevent, was that the speculative enthusiasm of the bull market had, by 1929, become substantially disconnected from the interest rate mechanism. Even as call money rates rose to 8, 9, 10%, the potential gains from a rising stock market were sufficient to make those borrowing costs seem trivial. The margin accounts continued to expand, the market continued to rise, and the Federal Reserve, lacking the regulatory authority to directly constrain margin lending, found itself in the position of a physician who can diagnose the disease but cannot administer the cure. There were other symptoms that a careful observer might have noticed, accumulating quietly through the summer and early autumn of 1929. Steel production, which had been a reliable leading indicator of economic activity through the 1920s, had begun to plateau. Railway car loadings, the movement of goods across the country, another reliable measure of real economic activity, were declining slightly. The construction industry, which had been one of the primary drivers of the decade's prosperity, was showing signs of softness in several major markets, and there was Florida. The Florida land boom of the mid-1920s had been, in miniature, a preview of everything that would play out on the national stage in 1929. Beginning around 1924, land prices across the state had begun rising at rates that bore no relationship to the underlying productive value of the property being traded. Swampland was subdivided and sold as future resort communities. Lots in developments that existed only on paper changed hands multiple times before any construction had begun. The promoters were not all dishonest. Many genuinely believed in the growth they were projecting. But the structure of the market had decoupled from the structure of reality in ways that made a reckoning inevitable. That reckoning arrived in 1926, accelerated by a series of hurricanes that caused catastrophic damage across the region and revealed, with uncomfortable clarity, how little of what had been sold actually existed in usable form. Land prices collapsed. The investment that had poured into Florida drained away as rapidly as it had arrived. The boom ended, and in its ending it left behind a landscape of half-built developments, abandoned lots, and investors whose Florida paper was now worth a fraction of what they had paid. The national financial press largely treated the Florida collapse as a regional curiosity, the natural consequence of excessive enthusiasm in a specific market, with no broader implications for the economy as a whole. This interpretation was, in retrospect, a failure of the analytical imagination. The Florida boom had demonstrated, clearly and specifically, that American investors in the 1920s were willing to buy at prices that could not be justified by any calculation of underlying value, driven purely by the expectation that someone else would buy at a higher price tomorrow. This is the anatomy of a speculative bubble, and it was visible to anyone who chose to look at it closely. Few chose to look. The prophets of the coming crash shared a particular burden that is worth naming directly, because it is a burden that recurs throughout the history of financial crises. Being right too early is, in practical terms, almost indistinguishable from being wrong. If you warn that the market is overvalued in 1927 and the market continues to rise through 1928 and into 1929, you have not been proved right. You have merely been proved premature. And in a culture that equated caution with timidity and dissent with failure of nerve, being premature was its own form of humiliation, and so the warnings accumulated and were absorbed and were rationalized and were set aside. The market rose, the trusts expanded, the margin accounts deepened, and the autumn of 1929 arrived with the measured inevitability of a season that has been waiting somewhere just beyond the visible horizon for a very long time. There is one more warning worth examining, one that did not come from an economist or a statistician, but from the structure of the market itself, visible to anyone who chose to read it carefully. In the summer of 1929, the breadth of the market's advance began to narrow. What this means, in practical terms, is that while the Dow Jones Industrial Average, composed of 30 large, heavily traded stocks, continued to push upward, the wider universe of stocks was not following. Hundreds of companies whose shares were traded on the New York Stock Exchange had already begun to decline from their own peaks months before the October crash. The railroad stocks, which had been among the drivers of earlier bull markets, were lagging. The agricultural stocks, reflecting the continued weakness of the farm economy, were trailing badly. The market's headline numbers were being sustained, in the late summer of 1929, by a relatively small number of heavily weighted stocks. the radio corporations and the General Electrics and the great utilities companies, while a large portion of the market had already quietly turned. This narrowing of market breadth is, to the trained technical analyst, one of the clearest warning signs of an advance that is running out of energy. A signal that the enthusiasm sustaining the headline indices is becoming increasingly concentrated and therefore increasingly fragile. But in 1929, the discipline of technical analysis was not yet well developed, and even those who understood the concept were operating without the computational tools that would later make such analysis accessible and routine. The signal was there, it was simply not widely read. Among those who did read it was a trader in New York whose name does not appear in the major historical accounts of the crash, but whose private correspondence, preserved in a university archive and examined by later historians, reveals that he had significantly reduced his market exposure by August 1929 specifically because he was troubled by the narrowing breadth. He did not know precisely when the market would turn or how far it would fall. But he knew, with the quiet certainty of someone who had spent years attending to the market's own language, that something was wrong with the picture. He told a friend in a letter written in late August that the market reminded him of a very large and very beautiful building that was still standing but whose foundation he suspected had been quietly compromised. He could not see the foundation. Nobody could see it, really. But he could feel, in the way that the building was responding to the ordinary stresses of wind and weather, that something beneath the surface was not as it should be. By October, he would know that he had been right. But being right brought him no particular satisfaction. He had saved his own money. He could not save anyone else's. October arrived in New York with a coolness that the city's inhabitants welcomed after the lingering warmth of an unusually mild September. The trees in Central Park were beginning their slow transformation. The maples first, then the oaks, then the sycamores along the winding paths that led down toward the reservoir. People walked to work in the mornings with their collars turned up slightly, their breath just visible in the early air, and if they paused to look at a newspaper headline about the stock market, the news was not alarming exactly, but not entirely comfortable either. The market had in fact been weakening since early September. The Dow's peak of 381.17 had been reached on September 3rd, and in the weeks that followed, a slow, persistent erosion had set in. The decline was not dramatic. Nothing that qualified as a crash, nothing that the financial press was yet treating as anything more than a healthy correction after an extended advance. But for those who were watching carefully, there was something different about the texture of this particular decline. Previous declines during the bull market had tended to be sharp and brief. The market would fall, the banking establishment would issue reassuring statements, a wave of bargain hunting would send prices back up, and the general upward trend would resume. This pattern had repeated itself often enough that it had become for many investors a reliable feature of the landscape, not something to fear but something to exploit, a chance to buy more shares at temporarily reduced prices. But the October decline had a different character. It was slower, more persistent, and accompanied by a volume of selling that was higher than the bargain hunting volumes on the recovery days. The market was, if you looked at it with the right kind of attention, beginning to leak. There is a question that haunts this period, and it is worth sitting with. Why did the selling begin when it did? What changed between September 3rd, when the Dow reached its historic peak, and the weeks that followed? The honest answer is that no single event triggered the decline. The market's peak and subsequent fall were the product of a confluence of factors that had been building for months or years, none of which was sufficient on its own to produce what followed, but which together created a structure of accumulated fragility that was waiting for only the lightest additional weight to begin its collapse. The Federal Reserve's interest rate increases had, by September 1929, made their way into the broader credit markets with sufficient force to begin constraining business activity. Companies that had been expanding aggressively through the boom years were finding it more expensive to borrow, and some were beginning to pull back. The earnings reports that began arriving in the autumn were, in several significant cases, somewhat below the projections that had been used to justify the stock's elevated prices. Not dramatically below, not disastrously below, but enough to raise in attentive minds a quiet question about the gap between expectation and reality. And there was the matter of what was happening in England. The Hatchery affair, which broke in London in mid-September 1929, was not the primary cause of the American crash. The American market's vulnerabilities were entirely domestic in origin, but it contributed to a mood of unease that spread across the Atlantic with the dispatch of the telegraph wires. Clarence Hattrey was a British financier who had built an impressive-looking empire of industrial companies and financial vehicles, and who had, it emerged in September 1929, been sustaining that empire through a program of fraudulent securities issuance of sufficient scale to qualify as one of the larger financial frauds in British history. When the fraud was discovered, Hattrey was arrested, his empire collapsed, and British investors who had been holding his securities faced substantial losses. The direct financial connection between Hattrey's collapse and the American market was limited. But the psychological connection was real. The Hattrey affair reminded investors on both sides of the Atlantic that the impressive-looking financial structures of the late 1920s were not invariably what they appeared to be, that behind a facade of professional management and diversified holdings, it was possible for a structure to be sustained by something considerably less solid than its outward appearance suggested. In the first 2 weeks of October, the selling on the New York Stock Exchange intensified. The ticker tape, that long ribbon of paper that spooled continuously from machines installed in brokerage offices across the country, printing the prices of each trade as it was executed on the exchange floor, began running behind schedule on particularly heavy trading days. This was itself a source of unease. When the ticker ran late, investors in offices far from Wall Street were receiving price information that was minutes or even tens of minutes old, making it impossible for them to know, with any confidence, what their holdings were actually worth at the moment they were trying to make decisions about them. The sensation of watching a market decline through a delayed ticker is a particular kind of anxiety, one that has no entirely adequate analogue in the modern world of instantaneous electronic information. You would sit in a brokerage office in, say, Kansas City or Atlanta, watching the tape unspool, and you would see prices falling, and you would know that those prices were old, that the actual market was already somewhere below what you were reading, but you would not know how far below or how fast it was moving. The uncertainty was its own form of pressure, pushing some investors to sell before they knew what they were selling into, and trapping others in paralysis until the decisions were made for them. By the third week of October, the paralysis was giving way to action. The selling was becoming more sustained, more broad-based, more difficult for the optimists to dismiss as temporary. Stocks that had seemed impervious to decline, the Radio Corporation of America, whose shares had risen from roughly 85 in 1928 to a peak of 549 in 1929. The great utilities companies whose stock prices had been driven to extraordinary multiples by the investment trust that held them, were now falling with a persistence that margin account holders could not afford to observe in silence. The margin calls were beginning, not the flood that would come later, not yet, but the early trickle that precedes a flood, the quiet telephone calls from brokers to clients, the polite letters requesting additional funds to restore the required equity ratios, the private conversations that began, "We regret to inform you." For investors who had borrowed heavily against their holdings, a decline of even 10 or 15% from the peak was sufficient to generate a margin call, and the response to a margin call for an investor who did not have the cash reserves to meet it was forced selling, the liquidation of shares at whatever price the market would bear, adding further selling pressure to a market that was already struggling to absorb what was already there. This is the mechanism that transforms a market decline into a crash, not merely the initial selling, but the cascade that selling triggers through the margin system. A falling market generates margin calls. Margin calls generate forced selling. Forced selling pushes prices lower. Lower prices generate more margin calls. The spiral, once it begins to turn with sufficient speed, can become very difficult to stop. The financial establishment, watching this machinery begin to engage in the third week of October 1929, chose, with a few notable exceptions, to issue reassurances. Charles Mitchell of National City Bank returned from Europe, where he had been conducting business, and told reporters that the market's fundamentals remained sound and that any weakness was temporary. The financial pages of the major newspapers quoted a succession of economists, bank presidents, and market analysts, all offering variations on the same theme. This is a correction, not a crisis. The economy remains strong. The declines present a buying opportunity for the patient investor. These were not entirely cynical statements. Some of the men who made them believed what they were saying. Others were aware that public confidence was itself a component of market stability, that a sufficiently pessimistic pronouncement from a sufficiently prominent figure could become, through its effect on investor behavior, a self-fulfilling prophecy. There was, in other words, a logic to the optimism even when the optimism was not entirely warranted. But the tremors were real, and they were deepening. And in the pre-dawn hours of Thursday, October 24th, 1929, something shifted in the architecture of the market, something that no amount of reassurance, however sincerely delivered, was going to stop. October 24th, 1929 begins the way market days always begin, with the measured ceremony of the opening bell, the gathering of the floor traders in their coloured jackets, the quiet hum of the ticker tape machines warming to their purpose. The morning air over lower Manhattan carries the first real cold of autumn. On the street outside the exchange, the usual crowd of messengers and clerks and spectators has gathered, as they always gather, on the steps and the sidewalk of Broad Street. But something is different today, and the men on the trading floor know it before the first trade is executed. The sell orders that have been arriving since the previous afternoon, accumulating in the order books overnight, stacking up in the quiet hours when the exchange is closed, but the anxiety of investors continues to find its way into written instructions to their brokers, are unusually heavy, not merely in volume but in character. These are not the orders of investors who are taking profits or rebalancing portfolios. These are the orders of people who need to get out, people who have received margin calls and cannot meet them, people who have been watching the market fall for 3 weeks and have decided that waiting longer is a risk they can no longer afford. The opening is chaotic. From the moment trading begins, prices fall sharply, not drifting downward as they had during the long October softening, but dropping with a speed that causes the floor traders to shout their orders with an urgency that is unfamiliar even to men who have spent their careers in one of the noisiest environments in the world. The ticker tape begins to fall behind almost immediately. Within the first half hour of trading, the tape is running 5 minutes late. By mid-morning, it is running 15 minutes behind. By early afternoon, the lag will reach 90 minutes. Across the country, in brokerage offices from Boston to San Francisco, investors are watching tape that no longer tells them what the market is doing. They are watching history, prices from 15 minutes ago, 30 minutes ago, an hour ago, while the actual market moves in directions they cannot see. The anxiety this creates is its own accelerant. Some investors, unable to bear the uncertainty, issue sell orders without knowing what price they will receive. Others, frozen by the same uncertainty, hold positions they might otherwise have liquidated. The market is operating in these hours in a fog of its own making. By 11 o'clock in the morning, something close to panic has taken hold of the trading floor. The volume of selling is unlike anything the exchange has previously handled. Stocks that had seemed solid, the blue chips, the great industrial companies, the utilities that had been the foundation of the investment trusts, are falling in ways that defy the normal expectations of a correction. The Radio Corporation of America, which had been trading above 100 at the beginning of the month, falls through 80, then 70. Steel, which had been a reliable pillar of the industrial economy, is down sharply. The utilities, those highly leveraged favourites of the investment trusts, are collapsing at rates that are generating margin calls simultaneously in dozens of trust portfolios, each call triggering forced selling that pushes prices lower still. And then, at approximately noon, something remarkable happens. 5 men meet in the offices of J.P. Morgan and Company at 23 Wall Street, a building that, by virtue of its location directly across from the stock exchange and its historical associations with the Morgan banking dynasty, occupies a particular symbolic position in the geography of American finance. The 5 men are Thomas Lamont of Morgan, Albert Wiggin of Chase National, Charles Mitchell of National City, William Potter of Guarantee Trust, and Seward Prosser of Bankers Trust. Together, they represent the apex of American commercial banking, the institutions whose combined assets dwarf anything else in the American financial system. The atmosphere in the Morgan offices on that Thursday noon is one that the participants would later describe in ways that converge on a single quality: controlled urgency. These were men accustomed to making large decisions in small rooms. They had done it before in other crises. The Panic of 1907, most notably, when the elder J.P. Morgan himself had convened a similar gathering and, through the sheer force of his authority and his checkbook, had prevented what might have been a catastrophic banking collapse. That intervention had worked. The memory of it, the lesson that concerted action by the major banking institutions could, in a moment of acute crisis, turn the market's psychology. was part of what brought these 5 men to the Morgan offices on the noon of October 24th. The question they faced was whether the lesson of 1907 applied to the situation of 1929, whether the forces at work this Thursday were the kind that could be checked by a demonstration of institutional confidence, or whether they were something larger and more structural, something that no amount of purchasing power, however concentrated, could ultimately arrest. Thomas Lamont, who would serve as the group's spokesman to the press, was careful in his public characterization of what the pool was attempting to do. He did not claim, as some reports would later suggest, that the pool was designed to stabilize the market at its existing levels. He described it, more modestly, as an attempt to provide an orderly market, to ensure that sellers could find buyers, that prices would not be driven below their reasonable value by a temporary absence of demand. This distinction was real and important. The pool was not promising that prices would not fall further. It was promising that they would not collapse into a vacuum, that the mechanism of the market would continue to function even under extraordinary stress. What they agree to do in the space of approximately 20 minutes is commit a combined pool of approximately $240 million, some accounts say more, to be used for the purchase of stocks on the open market. The explicit purpose is to demonstrate to investors, through the act of buying rather than merely the act of speaking, that the market's major institutional participants believe current prices represent value rather than warning. This is, in effect, an attempt to reverse a stampede by standing in its path with a very large amount of money. The execution of this plan falls to Richard Whitney, the floor broker for the Morgan firm, a patrician figure, impeccably dressed, famously composed, the kind of man whose bearing alone conveys confidence. Whitney walks onto the trading floor of the New York Stock Exchange at approximately 1:30 in the afternoon, makes his way to the post where United States Steel is traded, and places a bid for 10,000 shares at $2.05, a price several dollars above the last traded price. The effect is immediate and electric. The floor traders, who know Whitney by sight and understand what his presence at that moment means, respond with something close to a cheer. The news of the Morgan Pool's intervention spreads through the brokerage offices of New York with a speed that seems to outpace even the delayed ticker. The big money has stepped in. The banks are buying. The floor has been reached. And for a while, a critical while, it works. Whitney moves through the trading floor, placing bids for other blue-chip stocks at prices that signal support. The selling slows. Prices recover. By the close of trading on October 24th, the market is actually up slightly from its worst levels of the day, and the general sense among the financial press and the banking community is that the intervention has succeeded, that the panic has been checked, that the psychology of the market has been stabilized, that the worst is over. The front pages of the evening newspapers reflect this cautious optimism. The Morgan intervention is reported approvingly. Bankers issue statements. The atmosphere as the markets close for the day is one of relief, guarded, uncertain, but genuine. The system has been tested, and the system has held. What no one on the floor of the exchange, no one in the offices of the great banks, no one in the editorial rooms of the financial press fully understood on the evening of October 24th was that the Morgan Pool had not resolved the underlying problem. It had, at considerable expense and with genuine skill, addressed the symptom, the panic, while leaving the cause entirely intact. The margin accounts were still dangerously extended. The investment trusts were still holding portfolios of overvalued stocks on borrowed money. The gap between stock prices and underlying economic reality was still, despite the day's declines, large. The structural fragility that had been building for 5 years had not been eliminated by an afternoon of well-timed buying. It had merely been persuaded for the moment to hold still. That evening, President Herbert Hoover issued a statement through his press secretary, affirming that the fundamental business of the country was on a sound and prosperous basis. John D. Rockefeller, the elder statesman of American capitalism, announced that he and his son had been buying sound common stocks for some days, a statement that was widely reported and widely cited as evidence that those with the deepest knowledge of business conditions saw the decline as a temporary aberration. The market would be closed on Saturday, as it always was. There was a weekend ahead, 2 days in which the immediate pressure would be suspended, in which investors could collect themselves, in which the banking community could assess the situation and, if necessary, make additional plans. What most of those investors did over that weekend was not collect themselves, it was worry. And the worry, accumulating through the quiet hours of Saturday and Sunday, would arrive at the exchange on Monday morning wearing a very different face than the cautious optimism of Thursday afternoon. Friday, October 25th. The market opens to heavy trading and falls again, not as sharply as Thursday, not with the same quality of raw panic, but steadily, persistently, in a way that suggests the Morgan Pool's intervention has stabilized the psychology of the floor traders without addressing the larger forces pressing against the market. The pool continues to buy. The tape falls behind again. By the close of Friday, the week's losses are substantial by any historical measure, though the absolute numbers, a decline of perhaps 10 to 15% from the early October highs, are not, in isolation, the stuff of epoch-defining catastrophe. It is in the gap between the trading days that the real story of this particular weekend is written. Saturday, October 26th. There is no trading on Saturdays. The exchange is closed, the tickers are quiet, the floor of Broad Street is empty of its usual weekday crowd. But the offices of brokerage firms across the country are not quiet. They are filled, on this particular Saturday, with clerks and accountants working through the backlog of paperwork generated by Thursday's extraordinary volume, confirming trades, reconciling accounts, calculating the precise state of each margin account in the firm's books. And what those calculations reveal, in firm after firm, is that thousands of accounts are now below the required margin levels. The week's losses have eaten through the equity cushion of investors who had borrowed at maximum leverage to hold their positions. Margin calls, formal, written demands for additional funds, need to go out before Monday's opening. The clerks work through Saturday afternoon and into the evening, preparing the letters and telegrams that will, over the course of the weekend, arrive in the mailboxes and on the doorsteps of investors across the country. Sunday, October 27th. The newspapers publish their weekend editions, and the financial coverage falls into two distinct camps that reflect the genuine uncertainty of the moment. The more optimistic papers, those aligned with the financial establishment, emphasize the banking community's intervention, the fundamental soundness of the economy, the historical pattern of market recoveries following periods of excess. The more sceptical papers begin for the first time to use language that carries the weight of genuine alarm, phrases like watershed moment and unprecedented volume and the question of underlying values. What is a man to make of his newspaper on this particular Sunday morning? You find yourself imagining him, perhaps sitting in the front room of a modest house in one of the outer boroughs of New York, or in a rented apartment in Philadelphia, or on the porch of a house in a small Midwestern city whose name would mean nothing to the financial historians who would later write about this weekend. He has a cup of coffee that has gone slightly cold. He has the newspaper. He has, somewhere in a desk drawer or a kitchen cabinet, the most recent statement from his brokerage account, numbers that were already out of date when they arrived by mail earlier in the week, numbers that no longer correspond to anything real, and he has, sitting in the quiet of his Sunday morning, a decision to make. Not a complicated decision in the mechanical sense. Either he meets the margin call, if one has arrived, by sending money he may or may not have, or he does not. If he cannot meet it, his broker will sell his shares on Monday at whatever price the market will bear, and his losses will be locked in, permanent and unrecoverable. If he can meet it, if he has the reserves, or can borrow from family or friends or his bank, he's betting that Monday will be better than Thursday, that the Morgan Pool and the Rockefeller announcement and the assurances of Herbert Hoover will prove to have been correct, that the market will stabilize and recover, and that his patience will eventually be rewarded. Across the country, tens of thousands of people are making versions of this calculation simultaneously. The aggregate of their individual decisions, each one made in isolation, in the privacy of a Sunday morning, without knowledge of what anyone else is deciding, will arrive at the New York Stock Exchange on Monday morning as a collective verdict. Monday, October 28th, 1929. The verdict is not ambiguous. The market opens and immediately falls, not with the hesitant, searching quality of the early October weakness, not with the mixed character of the previous Thursday, when panic and intervention had competed for the day, but with a directness that removes any possibility of misinterpretation. The selling is enormous. The volume in the first hour of trading exceeds anything previously recorded. The ticker falls behind almost immediately and stays behind, running 60, 70, 80 minutes late as the transactions pile up faster than the system can process them. The Morgan pool attempts again to provide support, but the scale of the selling has outgrown the pool's capacity to absorb it. For every bid that the pool places, there are many more sellers, not the institutional sellers of the previous week, but the cascade of forced liquidations from thousands of margin accounts, each sale adding to the pressure on prices, each price drop generating new margin calls, each new margin call generating new sales. The Dow Jones Industrial Average falls nearly 13% in a single session. It is, at the time of its occurrence, the largest single-day percentage decline in the exchange's history. Stocks that the investment community had regarded as blue chips, solid, reliable, the kind of holding that a prudent investor could maintain without anxiety, fall by amounts that would, in any other context, have been described as catastrophic. But Monday is not the worst day. Monday is merely the preparation for the worst day. That evening, the banking establishment meets again. The conversations are different in character from the confident deliberations of the previous Thursday. The mood is one that participants would later describe, with some consistency, as somber. The question is no longer whether the market is experiencing a correction. The losses of the past week have settled that question definitively. The question is whether there is any mechanism available to the banking system to arrest what is beginning to look very much like a full-scale collapse. The answer, which emerges from the conversations of Monday evening with a clarity that no one finds comfortable, is essentially no. The pool has resources, but those resources are finite, and the selling pressure it is facing is not. The fundamental problem, the enormous overhang of margin debt that must eventually be liquidated regardless of the intervention, cannot be solved by buying stocks on the open market. It can only be solved by the passage of time and the reduction of that debt, a process that is, by definition, going to involve further declines in stock prices. The men who reach this conclusion on Monday evening do not announce it publicly. They continue to issue statements of reassurance. They continue to support the market where they can. But the nature of their private deliberations has shifted in ways that would only become clear much later, from active resistance to something closer to orderly management of an outcome that can no longer be prevented. Tuesday, October 29th is coming, and nothing that could be done in the quiet hours of Monday evening is going to change what Tuesday would bring. The morning of October 29th, 1929 begins in darkness, not the darkness of a normal pre-dawn, not the ordinary darkness of a city not yet awake, but the particular darkness of a world that knows, even before the first light has come over the Hudson, that today will be different from every day that preceded it. The brokerage offices that have been working through the night are still lit, their windows glowing in the pre-dawn streets, the clerks inside them still processing the paperwork from Monday's session, while simultaneously preparing for what Tuesday will bring. The sell orders have been arriving since before midnight. They have been arriving by telegram, by telephone, by letter, by personal visit from investors who cannot sleep, and who have decided in the small hours of the morning that they cannot bear to wait for the opening bell to discover what the market will do to what remains of their wealth. They want to sell now before the market opens, and their brokers have accepted the orders and logged them and added them to the queue that will execute when the exchange begins trading at 10 o'clock. By 9 in the morning, the queue is already extraordinary. The floor of the New York Stock Exchange fills with its usual crowd of traders and clerks and specialists. But the usual morning noise, the animated conversation, the occasional laughter, the general buzz of professional preparation, is muted today in ways that experienced floor traders will later attempt to describe to journalists and historians and Senate committees with only partial success. The closest analogy that several of them reach for is a physical sensation, the stillness before a storm, when the air pressure changes and the world goes quiet in a way that the body registers before the mind does. At 10 o'clock, the opening bell sounds. What follows is, by every measure available to describe it, the worst single day in the history of the New York Stock Exchange up to that point in time. The selling begins before the echoes of the bell have faded, and it does not stop. From the first minute of trading, prices fall, not in the lurching, intermittent way of the previous week's declines, but with a terrible steadiness, a quality of inevitability that strips away the normal human instinct to wait and watch and hope. The floor traders, who are accustomed to the emotional climate of the market and who can read its moods with the sensitivity of long experience, understand within minutes that this is not another Thursday, that there is no pool of buyers large enough to absorb what is being thrown at the market today, that the arithmetic of this session is going to resolve itself in only one direction. The ticker falls behind within the first 15 minutes and does not recover. It will run, at its worst, nearly 3 hours behind the actual trading on the floor. This means that investors across the country, watching the tape in the brokerage offices of 1,000 American cities and towns, are living in a different time than the market itself. They are watching prices from 2 hours ago while the market is already, somewhere ahead of the tape, at prices they have not yet seen and cannot anticipate. For many of these investors, the first indication that something extraordinary is happening comes not from the tape but from a telephone call. Their broker is calling, not with a margin call precisely. There is no longer any point in issuing margin calls for accounts that have already been wiped out, but with the notification that the firm has been forced to liquidate their position, that the shares they held are being sold, have been sold, will be sold at whatever price the market will give for them. The telephone is ringing in apartments and offices and shops across the country, and with each call, a piece of someone's financial life is being ended. On the floor of the exchange, the scene defies the language ordinarily used to describe financial transactions. The order clerks are overwhelmed. There are simply more orders arriving than the physical system of runners and hand signals and shouted bids can process with anything approaching its normal efficiency. Shares are being sold in enormous blocks, not by individual investors, but by brokerage firms liquidating entire portfolios simultaneously, dumping whatever they hold at any price the market will accept. Blue Ridge Corporation, the Goldman Sachs investment trust that had traded above 100 in the summer, falls to 3. Montgomery Ward falls from 49 to 38 in a single morning. General Electric, one of the most solid companies in America, loses a quarter of its value in hours. American Telephone and Telegraph, whose shares had been among the most widely held in the country. The stock that cautious, conservative investors had bought, on the assurance that a telephone company was as stable as utility could be, falls sharply, its ordinary shareholders helpless to do anything but watch the numbers on the tape, which are not the real numbers but the numbers from 2 hours ago, and which are already catastrophically low. By noon, more than 8 million shares have been traded. The final total for the day will reach 16.4 million shares, a record that will stand almost incomprehensibly for nearly 40 years. There is a detail from this day that deserves to be held carefully, because it captures something important about the human texture of the catastrophe. The telephone exchange serving the Wall Street district, the network of operators and cables that connected the financial district to the rest of the city and the country, was, for much of October 29th, functionally overwhelmed. The volume of calls being placed was beyond the capacity of the system to handle them. Investors trying to reach their brokers found the lines busy. Brokers trying to reach clients found the lines busy. Telephone operators, overwhelmed by the sheer volume of calls, were connecting people to the wrong parties, dropping connections mid-conversation, and in some cases simply unable to process the traffic at all. The result was a layer of informational chaos imposed over the already chaotic conditions of the market itself. People were making decisions, enormous decisions, life-altering decisions, based on incomplete and often incorrect information, separated from the people and institutions on whom they depended by a communication system that was, quite literally, unable to bear the weight of what was being asked of it. In the early afternoon, a rumour spread through the exchange that the president of Union Cigars had jumped from a building. It was not true, but it was believed, and it was repeated, and it spread through the trading floor and into the brokerage offices with a speed that the actual facts of the day could not match. The rumour captured something real about the emotional atmosphere of October 29th, even if its specific content was false. The sense that the losses of this day were of a scale that could break people, that the gap between what investors had believed they owned yesterday and what remained today was wide enough to be, for some, unbridgeable. The closing bell on October 29, 1929 sounds at 3 o'clock in the afternoon. The Dow Jones Industrial Average has fallen approximately 12% from its Monday close, which was itself down 13% from its Friday close. The week's cumulative losses represent a destruction of paper wealth that has no precedent in the history of American finance. The ticker tape continues to run for 4 hours after the market closes, processing the backlog of transactions that accumulated during the day. In brokerage offices across the country, clerks and accountants work through the evening calculating losses, notifying clients, preparing the documentation of what has just occurred. The tape finally falls silent at 7:15 in the evening. The streets outside the exchange are quieter than usual for a Tuesday night. People are walking home with a heaviness that is not quite grief and not quite shock, but something of both. The particular weight of a world that has changed in ways not yet fully understood, a weight that will only grow heavier as the days and weeks and months ahead make the full dimensions of the change visible. Inside the exchange, as the last of the tape finally spools through the machines at 7:15, the clerks who have been working since before dawn are beginning to understand the full dimensions of what they have witnessed and processed. They are exhausted in a way that goes beyond physical tiredness, exhausted in the particular way of people who have been required to function with professional precision during an event whose meaning they are only beginning to absorb. One of those clerks, a young man named Arthur from Queens, who has been working on the exchange floor for 18 months, will later describe the feeling in terms that have the clarity of youth and the precision of someone who was paying close attention. He will say that the strangest thing about the day was not the volume or the speed or the noise, though all of those were extraordinary, but the faces of the older traders, the men who had been on the floor through the previous crashes and panics and corrections, the men who had developed over years a professional equanimity that allowed them to function calmly in environments that would overwhelm most people. Those men, on October 29th, had faces that Arthur had not seen before on the trading floor. Not panicked. Panic was too acute a word, something more like the expression of people who have looked at something and understood that it is not going to stop. He would think about those faces for years afterward. They contained, he felt, a knowledge that he had not yet acquired, the knowledge of what it meant when a system reached the end of its tolerance, when the ordinary mechanisms of correction and recovery ceased to function, when the thing that was happening was not a disruption of the normal order, but a revelation of what the normal order had always contained. The city moved on through the evening of October 29th with the strange normalcy that follows catastrophic events. The restaurants opened for dinner, the theatres ran their shows, the trains carried people home to their boroughs and their suburbs. The daily machinery of urban life does not pause for market crashes. It continues, as it always continues, because the people who operate it have no choice but to continue. But there was something different in the air that evening, something that the people who lived through it would attempt to describe afterward, in terms that never quite captured it. A woman who operated a lunch counter on William Street, a block from the exchange, would tell a journalist some months later that the afternoon trade on October 29th was the quietest she had ever seen. Men came in, she said, and sat at the counter, and ordered their coffee or their soup, and said almost nothing. Not the comfortable silence of people who are simply at ease, a different silence, the silence of people who are carrying something they have not yet found words for. She refilled their cups. She asked no questions. She understood, without being told, that the questions she might have asked were not ones that anyone at her counter could answer. If you're drifting now, let yourself go. Subscribe so the next story is waiting when you return. Sleep well. The numbers are necessary, but the numbers are not enough. The Dow's percentage losses, the trading volumes, the capitalization figures, these are the skeleton of the story. The flesh and blood of it is the experience of the people who lived inside those numbers as they moved, who watched the arithmetic of their savings transform in the space of days into the arithmetic of ruin. Consider the story of a woman named Clara Steinberg. Not famous, her name borrowed here from the composite of hundreds of testimonies gathered by historians and journalists in the years following the crash. Clara is the wife of a commercial printer in Brooklyn. She and her husband have been married for 11 years. They have, over the course of their marriage, saved carefully and consistently, setting aside a portion of his wages each month, accumulating a reserve that by 1928 amounts to somewhere between $4,000 and $5,000, a sum that represents years of discipline and modest living, and the quiet, sustained effort of two people building something together. In early 1928, Clara's brother-in-law, a man who works in a downtown law office and considers himself well connected to the world of finance, suggests that they put some of their savings into the market. Not all of it, a portion, enough to benefit from what everyone around them seems to be benefiting from. He recommends a brokerage firm. He recommends several stocks, solid companies, he says, the kind that don't just go up and down but tend, over time, to go up. He offers to help them open the account. Claire and her husband discuss the idea for several weeks. They are cautious people. But the stories they hear from neighbours and friends and family, the gains that seem so reliable, so accessible, so clearly available to anyone willing to participate, gradually overcome their caution. They invest $2,000. Then, 6 months later, when the account has grown to nearly $3,000, they invest another $800. They are not buying on margin, their caution has extended at least that far, but they are now substantially committed to the market. By September 1929, their brokerage account is worth approximately $5,000, a gain of roughly 40% on their original investment. Clara's husband has begun to speak quietly of what they might do with that money in a few more years. A larger apartment, perhaps, or a house. The future, which had always seemed like something you worked towards slowly, seems suddenly closer. By November 1929, their account is worth $800. The story of Clara and her husband is not unusual. It is, in its essential shape, the story of millions of Americans. People who had approached the market cautiously, who had invested amounts they could genuinely afford to lose in theory, but could not in practice, who had watched their savings grow and had begun, gradually and understandably, to incorporate those paper gains into their vision of the future. When the crash stripped those gains away, it did not merely take money, it took the future that the money had made visible, the house, the security, the sense that the years of careful living were accumulating towards something. There were people whose losses were smaller in dollar terms, but larger in proportion. The retired postal worker in Baltimore who had invested his entire pension savings in investment trust shares, because a trust, he had been told, was the safest way to participate in the market, more diversified than the individual stocks, professionally managed, unlikely to lose value catastrophically. The shares of the trust he held went from 85 to less than 4 in the space of 2 months. What remained was insufficient to provide the retirement income he had planned for, and at 63 years of age he returned to work. There were also, of course, people for whom the crash represented a different kind of catastrophe. Not merely the loss of savings, but the loss of businesses, of employers, of livelihoods. The crash did not immediately produce mass unemployment. That would come later, as the deflationary spiral worked its way through the broader economy. But its early effects on confidence and credit rippled outward from the financial district with sufficient speed to affect businesses far removed from the stock market. Banks that had extended loans on the collateral of stock portfolios found those portfolios suddenly worth a fraction of the loans they secured. The arithmetic of these situations was brutal and simple. The bank needed to recover its money, the collateral was insufficient to cover the debt, and the borrower was ruined. And as the banks dealt with this arithmetic at scale, not in dozens of cases but in thousands, they became increasingly reluctant to extend new credit, to roll over existing loans, to do the business of lending that was the oxygen of the broader economy. The psychological effects were perhaps as significant as the financial ones. A quality of caution descended on the American economy in the weeks following the crash that would prove extraordinarily durable. People who had never been near the stock market, who had watched their neighbours' gains with mild curiosity and spent their own savings in bank accounts or under mattresses, found themselves infected by the general mood of uncertainty. If the stock market, that monument to American confidence and ingenuity, could do this, what else might prove unreliable? What bank was truly safe? What investment was truly secure? The answer for many Americans was that they did not know, and not knowing was itself a kind of answer. They spent less. They saved more, or tried to. They postponed purchases, cancelled plans, held money close. And this collective contraction of spending multiplied across tens of millions of households was one of the primary mechanisms through which the financial crash of October 1929 became the economic catastrophe of the 1930s. The ticker tape that ran through the brokerage offices of the country was by late October carrying only losses. It spooled out its steady ribbon of numbers, prices falling, volumes high, the relentless accounting of a financial system trying to find its flaw. And the people who watched it did so in an atmosphere of quiet that was not the quiet of calm, but the quiet of people who have run out of things to say. In the weeks following Black Tuesday, the newspapers published stories of financial ruin that were, even by the standards of journalism that had previously treated every market gyration as front-page news, remarkable in their directness. Men who had been millionaires in September were discovered to be, in practical terms, insolvent by November. The losses were not theoretical. They were real, documented, arrived at by arithmetic that could not be contested. And yet, and this is perhaps one of the most important things to understand about the autumn of 1929, the immediate aftermath of the crash was not, in the experience of most ordinary Americans, the Great Depression. That would come later, as the damage spread and deepened and the mechanisms of economic contraction compounded upon themselves. In October and November 1929, what most Americans felt was not yet the grinding poverty of bread lines and bank closures, but something more like the aftermath of a storm, a shakiness, a sense of altered landscape, an awareness that things that had seemed permanent and reliable were neither. The ticker had told them a story for years, a story of rising prices, accumulating wealth, a future that was getting better and more comfortable with each passing quarter. On October 29th, the ticker told a different story. And unlike the stories that had preceded it, this one could not be revised. There is another dimension to the human cost of the crash that tends to receive less attention in the historical literature, perhaps because it is less dramatic than the more visible forms of financial ruin, but which was in some ways more pervasive in its effects. This was the cost paid by people who had not been in the market at all, who had kept their savings in banks, or in bonds, or simply in the sock drawer of their bedroom, but who were affected nonetheless by the contraction of credit and confidence that the crash set in motion. The small business owner who could not renew the bank loan that he had relied upon to fund his inventory was not a stock market speculator. He was a man who sold hardware or groceries or furniture, whose business was fundamentally sound, whose customers existed and had real needs, but who found himself, in the months after the crash, unable to access the credit that was the oxygen of his enterprise, because the bank that had previously supplied it was now conserving its resources against losses that were not yet fully calculated. The worker at the factory that closed was not a margin account holder. He was a man with a specific set of skills developed over years of practice at a specific kind of machine or a specific kind of process, whose employer had, in the new environment of contracting credit and declining consumer confidence, found it necessary to reduce production and, ultimately, to close. He had not bought on margin. He had not purchased investment trust shares. He had simply worked, and the system whose functioning he depended upon for his livelihood had, through mechanisms he had no part in creating, failed in ways that made his labour unnecessary. The crash of 1929 did not distinguish between those who had participated in the speculation and those who had not. It spread its consequences across the economy with the indifferent thoroughness of a natural disaster, touching people who had made every reasonable financial decision and people who had made none. This is part of what made it so demoralizing, not merely the scale of the loss, but its arbitrariness, the sense that prudence and caution had provided no protection against a catastrophe whose origins lay in the decisions of others, and yet the stories also include something else, something that tends to be obscured by the inevitable focus on collapse and ruin. They include evidence of the extraordinary resourcefulness and mutual support that communities deployed in the face of disaster. Neighbours sharing food, families taking in relatives who had lost their homes, churches and settlement houses expanding their services beyond any previous capacity. The informal networks of mutual aid that had always been part of working-class and immigrant community life in America were, in the Depression years, stretched to their limits and beyond, and in many cases they held. This too is part of the story of what Black Tuesday set in motion. Not only the loss, but the response to the loss. Not only the failure of the financial system, but the resilience of the human systems that existed alongside it, and beneath it, and, in some ways, in spite of it. Not everyone lost money in the crash of 1929. This is a fact that tends to disturb people when they first encounter it, a disturbance that is, in itself, revealing about how we think about financial catastrophes and the human behaviour they contain. Jesse Livermore was 52 years old in October 1929, and he was, by any reasonable measure, one of the most extraordinary financial operators in American history. He had begun his career as a quotation board boy in a Boston brokerage office at the age of 14, chalking up stock prices as they came in over the wire, absorbing the movement of numbers with a sensitivity that would, over the following decades, make him both famous and notorious in the financial world. He had made and lost fortunes multiple times, had been bankrupted twice and twice rebuilt himself, and had developed, through decades of disciplined observation, a theory of markets that centered on what he called the path of least resistance, the direction in which prices were most naturally inclined to move, regardless of the prevailing sentiment about where they ought to be. By the summer of 1929, Livermore had concluded that the path of least resistance in the American stock market was downward. This was not a sudden revelation. It was the product of months of observation, watching the quality of the market's advances, noting the declining breadth of the upward moves, observing that the market was increasingly being carried by a smaller and smaller number of individual stocks, while the broader list grew sluggish, registering the resistance the market encountered each time it attempted to push through certain price levels. These were the signals that Livermore had learned across decades of trading to treat with respect, not as certainties, but as probabilities that warranted significant financial commitment. He began building a short position. In the language of financial markets, to sell short is to sell shares you do not own, borrowing them from a broker and selling them in the open market, with the obligation to buy them back later at whatever price the market offers. If the price has fallen in the interim, you buy back at the lower price, return the shares, and pocket the difference. It is, in essence, a bet that prices will decline, executed with borrowed securities rather than borrowed money. Livermore's short position in the summer and autumn of 1929 was, by the standards of any era, breathtaking in its scale. He was short across dozens of stocks simultaneously, in amounts that represented tens of millions of dollars of exposure. The position required extraordinary nerve, and crucially the financial reserves to maintain it through the periods when the market rose rather than fell, because each upward move increased the cost of the borrowed shares and required Livermore to provide additional collateral to his brokers. There were days in September and early October 1929 when Livermore's short position was losing money as the market stabilized or rebounded, when the Morgan Pool's interventions drove prices up and threatened to squeeze the short sellers by making their borrowed shares more expensive to buy back. On those days, the mathematics of his position required iron discipline, the willingness to hold a bet that was, temporarily, going wrong, on the conviction that the fundamental analysis was correct and the market's recovery was temporary. When the crash came, the position paid. The precise figure of Livermore's profits from the 1929 crash is disputed by historians. Some accounts put it at $100 million, others at somewhat less, and the difficulty of verifying the number is compounded by Livermore's own tendency towards self-mythologization. But the general magnitude is not in serious doubt. He made, in the weeks between mid-October and early November 1929, more money than most Americans would earn in several lifetimes. The public reaction to Livermore's success was not, on the whole, admiring. In the immediate aftermath of the crash, the financial press and the political establishment were already constructing a narrative about who bore responsibility for what had happened, and short sellers, who profited from declining prices, were a convenient part of that narrative. If someone had made money while everyone else was losing it, the reasoning went, they must have in some sense caused the losing. Livermore received death threats. He was required to travel with bodyguards. His name appeared in newspaper editorials with the kind of language ordinarily reserved for people who had committed crimes against society. This reaction is worth sitting with, because it illuminates something important about how human beings process financial catastrophe. The loss of money on an enormous scale creates a need for explanation, a need for the disaster to be the result of something someone did, rather than the result of a system operating according to its own internal logic to an outcome that was, in retrospect, entirely foreseeable. Livermore had not created the overvaluation of the 1920s market. He had not created the margin debt. He had not promoted the investment trusts or encouraged the ordinary American to put his savings into the market at prices that could not be sustained. He had simply looked at the structure that others had built and concluded correctly that it would fall. There were others who made similar conclusions and similar profits, though none with quite Livermore's scale or flair. Albert Wiggin of Chase National Bank had, in a detail that would emerge only later and cause enormous scandal, been short-selling his own bank's stock during the crash, profiting personally from the decline of the institution he was supposed to be protecting. This was not merely a moral failure, but a specific illustration of the conflicts of interest that riddled the financial system of the 1920s, a system in which the same people who managed public institutions were operating private accounts with information that no ordinary investor could access. The story of the men who profited from the crash is not a simple story of villains and heroes. Livermore himself would be bankrupt again by 1934. His fortune dissipated through a combination of trading losses and personal extravagance. Proof, if proof were needed, that the ability to read a market in one direction does not guarantee the ability to read it in all directions at all times. The market's complexity is not ultimately mastered by anyone. It can only be, at best, partially and temporarily understood. What the short seller's profits illuminate more than anything else is the nature of the market itself, the fact that it is not a system designed to produce uniformly distributed outcomes, but a mechanism for transferring wealth from those who are wrong about prices to those who are right about them, regardless of which direction the prices are moving. The crash of 1929 destroyed the savings of millions of ordinary Americans. It also made a handful of people extraordinarily wealthy. Both things are true simultaneously, and both things are part of the same event. This is one of the hardest aspects of financial history to hold in the mind, not because it is complicated, but because it requires us to resist the instinct to make the story simpler and more morally coherent than it actually was. The market is not a morality play. It does not punish the wicked and reward the virtuous. It rewards, when it rewards at all, those who are correct about what prices will do next, a quality that bears only an incidental relationship to wisdom, or virtue, or the ordinary human categories of desert. Jesse Livermore understood this better than almost anyone of his generation, and what he understood, looking at the American stock market in the summer of 1929, was that prices were going down. He was right, and being right, in that particular instance, made him $100 million and 100,000 enemies. The crash was not the Depression. This distinction is important, and is frequently overlooked in the popular memory of this period. The tendency to compress the events of October 1929 and the suffering of the 1930s into a single continuous catastrophe, as though Black Tuesday and the breadlines of 1932 were a single unbroken event rather than the beginning and the middle of a process that unfolded over years. The Depression was not inevitable from the moment the market fell. There were choices made in the months and years that followed the crash, by the Federal Reserve, by the Hoover administration, by Congress, by the banking system, that deepened and prolonged what might otherwise have been a severe but recoverable recession. Understanding the crash requires understanding not merely what happened on October 29th, but what happened in its aftermath, and why the American economy took the path that it did. In November and December of 1929, the immediate financial damage was being absorbed. The stock market continued to decline, but more slowly. The acute panic of late October gave way to a grinding, persistent weakness that would characterize the market for the next 3 years. Banks were assessing the damage to their loan portfolios. Businesses were revising their expansion plans downward, but unemployment had not yet risen dramatically, and for ordinary Americans who were not directly involved in the stock market, life in the final months of 1929 was not yet visibly transformed. President Hoover's response to the crash was not passive, though it is often portrayed that way. He convened meetings of business and labor leaders and extracted public commitments, not binding, but public, to maintain employment levels and wages through the downturn. He launched a modest program of public works spending. He urged the Federal Reserve to make credit more available. These were not the responses of a man who believed that government should stand entirely aside from economic crisis. But Hoover's economic worldview was shaped by convictions that, under the circumstances that were developing, proved inadequate to the problem. He believed deeply in the importance of maintaining the gold standard, the principle that the dollar should be convertible into a fixed quantity of gold, and that the money supply should be constrained by the available gold reserves. He believed in balanced budgets, regarding deficit spending with a moral suspicion that went beyond economic analysis, and he believed, with a sincerity that was not cynical, but that proved costly, that the fundamental strength of the American economy would reassert itself if given time. The Federal Reserve, for its part, made what many economic historians now regard as its most consequential mistake. In 1931, faced with a wave of bank failures and a run on gold that threatened the international financial system, the Federal Reserve raised interest rates, the opposite of what a contracting economy needed. The decision was made in the service of defending the gold standard, a commitment that many of the world's major economies held in common, and whose demands were, in the early 1930s, systematically deflationary. The banks began to fail. Not one or two, thousands. In 1930, 1,352 American banks failed. In 1931, the number was 2,294. In 1932, 1,456 more. Each failure wiped out the savings of depositors who had trusted their money to institutions that proved unable to protect it. In an era before federal deposit insurance, the Federal Deposit Insurance Corporation would not be created until 1933, a bank failure meant total loss for ordinary depositors with no recourse and no recovery. The psychology of this wave of bank failures was, in some ways, even more damaging than the direct financial losses it produced. If you could not trust a bank, you kept your money at home, under a mattress, in a coffee can, in places that were safe from bank failure, but that also removed that money from the circulation of the economy. The withdrawal of deposits accelerated the failures of banks that might otherwise have survived. The contraction fed on itself. By 1932, the Dow Jones Industrial Average had fallen from its 1929 peak of 381 to a low of 41. This is the arithmetic of almost incomprehensible destruction, an 89% decline from peak to trough, a fall that erased nearly a decade of gains and then erased more besides. For investors who had held their positions through the crash, rather than selling, who had, in the autumn of 1929, listened to the advice that the market would recover, and that selling into a decline was the worst possible strategy. The patience that had seemed like wisdom in October 1929 had by 1932 produced losses that went far beyond what even the most pessimistic analyst had predicted in the first weeks after Black Tuesday. Unemployment reached 25% of the American workforce by 1932, 1 in 4 working Americans unable to find work. The agricultural sector, already under strain from the falling commodity prices of the late 1920s, was devastated further by the collapse of credit and the contraction of consumer spending. In the cities, the visible signs of the Depression accumulated, the bread lines that stretched around city blocks, the Hoovervilles, the improvised settlements of the unemployed that appeared on the outskirts of major cities and were named for the president with an irony that contained genuine bitterness, the men selling apples on street corners, the families sleeping in parks. These are the images that have passed into historical memory as the face of the Depression. They deserve to be held carefully, not as dramatic set pieces, but as the human consequences of a chain of events and decisions that began, or perhaps merely culminated, on the trading floor of the New York Stock Exchange in late October 1929. Hoover lost the 1932 presidential election to Franklin Roosevelt in one of the most decisive defeats in American political history. The margin was not close. Roosevelt carried 42 of the 48 states, received nearly 58% of the popular vote, and entered the White House in March 1933 with a mandate for change that was as unambiguous as democratic politics produces. What he inherited was an economy that had been contracting for more than 3 years, a banking system in acute crisis. He would declare a bank holiday in the first days of his administration, closing all banks temporarily to prevent a final catastrophic run, and a population whose faith in the institutions of American capitalism had been tested in ways that would shape the political landscape of the country for the next generation. The long winter was not yet over when Roosevelt took office, but the mechanisms that would eventually bring it to an end, the regulatory frameworks, the deposit insurance, the social safety net, the altered relationship between government and economy, were beginning to be assembled. They were assembled in large part from the wreckage of what the crash and its aftermath had revealed about the existing system's catastrophic inadequacy. It is worth pausing, in the middle of all this accumulating catastrophe, to ask a question that is easy to lose in the scale of the suffering. Was the Depression inevitable from the moment of the crash? Or were there roads not taken, decisions not made, that might have produced a different outcome? Economic historians have debated this question for nearly a century, and the debate has not been resolved to everyone's satisfaction. But a substantial body of scholarship, most influentially developed by Milton Friedman and Anna Schwartz in their landmark work on American monetary history, has argued that the Federal Reserve's failure to prevent the collapse of the money supply in the years following the crash was the single most important factor in transforming a severe recession into the Great Depression. The money supply fell by approximately one-third between 1929 and 1933, a contraction without precedent in American history, and the Federal Reserve, which had the tools to prevent this contraction, either failed to recognize the severity of what was happening, or, constrained by the ideology of the gold standard and the political dynamics of the period, chose not to use those tools. If this analysis is correct, and it remains influential though not universally accepted, then the Depression was not the inevitable consequence of the crash, but the consequence of the crash compounded by a specific policy failure, the failure of the central bank to fulfill its function as lender of last resort, to provide the liquidity that a contracting economy desperately needed to prevent the cascading bank failures that turned a financial crisis into an economic catastrophe. This is a sobering insight, not because it diminishes the human cost of what happened, but because it suggests that what happened was not simply an act of fate, a natural disaster that struck without warning and could not have been mitigated. It was, in significant part, a consequence of decisions made by people in positions of institutional responsibility who did not fully understand what they were dealing with, or who understood and chose the wrong response. The suffering of the Depression was immense, and it was not inevitable. That is perhaps the hardest part of the story to hold. Not the suffering itself, which is simply terrible, but the awareness that it was contingent, that different choices might have produced a different and less terrible outcome. Hoover knew this, in his way, by the end of his presidency. He was not a stupid man, and he was not an uncaring one. The image that history has attached to him, the figure of comfortable indifference in the face of mass suffering, is unfair to the complexity of his character and the genuine anguish of his final years in office. He had tried. He had tried within the constraints of what he believed and what he knew, and it had not been enough. That inadequacy was not simply personal failure, it was also the failure of a set of ideas about economics and government that the Depression had tested beyond their breaking point. The winter teaches, if it teaches anything, by the weight of what it takes away. In the spring of 1932, a subcommittee of the United States Senate Banking Committee began what would become one of the most consequential investigations in the history of American financial regulation. It was led eventually by a lawyer named Ferdinand Pecora, a Sicilian immigrant son from New York who had spent years as a prosecutor, and who brought to the banking hearings a quality of methodical, relentless questioning that the witnesses appearing before him found both exhausting and impossible to evade. The Pecora hearings, as they came to be called, were not initially designed to be the comprehensive indictment of the American financial system that they became. They began as a relatively modest inquiry into the causes of the market collapse. What they evolved into over months of testimony was a systematic exposure of the practices, conflicts of interest, and outright abuses that had characterized the financial industry during the 1920s, a reckoning conducted in public before the press, and with the full theatrical force of sworn testimony under penalty of perjury. The witnesses who appeared before Pecora's committee included the most prominent men in American finance: Charles Mitchell of National City Bank, Albert Wiggin of Chase National, Jack Morgan of J.P. Morgan and Company, Richard Whitney of the New York Stock Exchange. They arrived as figures of authority and departed in almost every case diminished, their practices exposed, their conflicts of interest documented, their carefully maintained public personas of disinterested professional expertise eroded by questions that revealed, beneath the dignity of the corner offices, something considerably less admirable. Mitchell, whose National City Bank had spent the 1920s aggressively selling securities to ordinary depositors, was revealed to have orchestrated the sale of hundreds of millions of dollars of bonds, some of them of highly questionable quality, to the bank's retail customers, while simultaneously taking personal loans from the bank at advantageous rates and engaging in transactions designed to reduce his personal tax liability. He resigned from National City Bank during the hearings and was subsequently indicted for tax evasion, though he was ultimately acquitted. Wiggin, whose Chase National Bank had been one of the pillars of the Morgan Consortium that intervened on Black Thursday, was revealed to have maintained a private account through which he had sold his own bank's stock short during the crash, profiting personally from the decline of an institution whose public posture was one of confident stability and support for the market. The details, when they emerged, produced a particular kind of outrage. Not merely the outrage of theft, which at least has a clear moral logic, but the more complex outrage of betrayal. of a man using the platform of public trust to enrich himself at the expense of the depositors and shareholders whose interests he was supposed to represent. Richard Whitney, who had walked across the floor of the exchange on Black Thursday to place the Morgan Pool's bids, that memorable act of ostentatious confidence that had temporarily steadied the market, was not exposed by the Pecora hearings, but his eventual reckoning was, in its way, even more striking. In 1938, nearly a decade after the crash, Whitney was convicted of embezzlement. He had been systematically stealing from accounts entrusted to his management, including the gratuity fund of the New York Yacht Club, and sentenced to 5 to 10 years in Sing Sing prison. The man who had been the face of Wall Street's confident self-rescue in its darkest hour had, it turned out, been a common thief. The legislative response to the Pecora hearings was substantial, and it permanently altered the structure of American finance. The Securities Act of 1933 required for the first time that companies offering securities for sale to the public provide full and accurate disclosure of their financial condition and the nature of what they were selling, the absence of which had allowed the investment trust promoters of the 1920s to construct and market instruments whose true structure was opaque to the people buying them. The Securities Exchange Act of 1934 created the Securities and Exchange Commission, an independent regulatory agency with authority to oversee the markets and enforce the disclosure requirements. The Banking Act of 1933, better known as the Glass-Steagall Act, addressed the conflicts of interest that had allowed commercial banks to use depositors' funds to underwrite and distribute securities while simultaneously collecting fees from the companies whose securities they were selling. The Act erected a wall between commercial banking and investment banking, prohibiting institutions from engaging in both activities simultaneously. This wall would stand for 66 years, until the Financial Services Modernization Act of 1999 dismantled it, a dismantling that some economists would later identify as a contributing factor to the financial crisis of 2008. The Federal Deposit Insurance Corporation, created in 1933, addressed perhaps the most immediately catastrophic consequence of the banking crisis, the destruction of ordinary depositors' savings through bank failure. For the first time, deposits up to a certain limit were guaranteed by the federal government. A bank could fail, but the depositor's money would be protected. The bank runs and panics that had accelerated the Depression's deepening, the self-fulfilling prophecies of financial collapse, in which the fear of failure produced the failures that the fear had anticipated, became over time a historical phenomenon rather than an ongoing risk. These reforms were not without their critics, and the critiques deserve acknowledgement because they contain genuine insight. Some argued that the separation of commercial and investment banking was too blunt an instrument, penalising legitimate activities alongside the abusive ones. Some argued that deposit insurance created its own perverse incentives, that a depositor who knew her money was guaranteed by the government had no reason to care whether the bank holding it was well managed or reckless, removing a natural market discipline. Some argued that the Securities Act's disclosure requirements were burdensome, and that their compliance costs would impede the efficient functioning of the capital markets. These critiques were not entirely without merit. The regulatory framework constructed in the Depression years was imperfect, as all regulatory frameworks are, shaped by the specific failures it was designed to address, and therefore sometimes poorly calibrated for the failures that had not yet been imagined. But the framework's overall effect on the stability of the American financial system in the half-century that followed its creation was substantial and largely positive. The period between the mid-1930s and the mid-1980s was one of the most stable in American banking history, with bank failures measured in the dozens rather than the thousands per year. The reckoning of the early 1930s produced in the end not merely the punishment of individuals, though punishment there was, but the reconstruction of an institutional framework. The people who had built the system that failed were held accountable, some more rigorously than others. But the deeper lesson of the hearings and the legislation was that the failure had not been purely a matter of individual bad actors. It had been a failure of structure, of a system that provided incentives for excessive risk-taking, inadequate disclosure, and the abuse of positions of trust, and that lacked the regulatory mechanisms to detect or constrain those abuses before they reached catastrophic scale. This insight, that financial crises are as much the product of structures and incentives as of individual character, was the most enduring and important contribution of the Depression-era reckoning. It was not a comfortable insight. It complicated the moral narrative. It suggested that the problem was not simply that some people had been dishonest, but that the system had made dishonesty easy and profitable and difficult to detect. Solving that problem required more than prosecuting the dishonest. It required rebuilding the architecture of the system itself. The rebuilding took years, and it was never entirely complete. But it began in those Senate hearing rooms in the early 1930s, in the testimony of men who had built something remarkable and something broken, and in the questions of a Sicilian immigrant's son who believed that the truth, however uncomfortable, was worth finding out. The Securities and Exchange Commission, created by the Securities Exchange Act of 1934, required a chairman, someone with the authority, the intelligence, and the political toughness to make the new agency something more than a paper institution. Roosevelt's choice was, by any measure, a surprising one. He appointed Joseph Kennedy, a man who had made substantial amounts of money in the very financial markets that the SEC was now designed to regulate, and whose methods had not always been conspicuously constrained by the principles of full disclosure and fair dealing. When critics pointed out the apparent contradiction of appointing a fox to guard the henhouse, Roosevelt's response was characteristic. He needed, he said, someone who knew where all the bodies were buried. Kennedy knew the financial world from the inside, its practices, its evasions, its hidden corners, its methods of obscuring reality from outside scrutiny. That insider knowledge, Roosevelt believed, was precisely what a regulatory body needed in its early years. Not the innocence of someone who had never been part of the system, but the experience of someone who understood how the system actually worked, rather than how it presented itself to the public. Kennedy proved, perhaps surprisingly, to be an effective regulator. He moved quickly to establish the SEC's authority, to demonstrate that the disclosure requirements of the new law would be enforced with genuine seriousness, and to begin building the professional staff and institutional culture that would allow the agency to function as a credible check on the financial industry. He was not without critics. He served only 1 year as chairman before returning to private life, but the foundation he established proved durable. What the New Deal's financial reforms collectively represented was something that went beyond any individual piece of legislation, a fundamental shift in the American conception of the relationship between financial markets and the public interest. Before 1929, the dominant view in American law and politics was that financial markets were private mechanisms, properly governed by the contractual arrangements of their participants, and subject to the ordinary laws of fraud and contract, but not the subject of systematic public regulation in the modern sense. The crash and its aftermath destroyed this view, not merely in the abstract, but in the lived experience of millions of Americans who had discovered, at considerable personal cost, that the existing framework was insufficient to protect them. The new framework that replaced it was built on a different conception, that financial markets, by virtue of their systemic importance to the broader economy, and their accessibility to ordinary citizens who lacked the information and expertise to evaluate what they were being sold, had a public dimension that justified public oversight. The investor who bought shares in a company or a fund was not merely entering into a private contract with the seller. She was relying on a system of disclosure and oversight that, if properly designed and enforced, could ensure that the information on which she based her decision was reasonably accurate and complete. This conception, which seems obvious now in the world the New Deal created, was genuinely radical in the context of 1933. It represented a transformation not merely of financial law, but of political philosophy, a recognition that the laissez-faire framework that had governed American economic life for most of the nation's history had proven, under the conditions of the modern industrial economy, to be inadequate to its stated purpose of producing broadly shared prosperity. History does not move in straight lines. It spirals, returning to familiar shapes at different scales, different speeds, under different names. The crash of 1929 left behind not merely the Great Depression and the regulatory reforms that followed it, but a set of patterns, vulnerabilities, and human tendencies that would recur, in altered form, in each subsequent generation that tested the limits of financial optimism. The market recovered, in time. The Dow Jones Industrial Average returned to its 1929 peak of 341 points, but not until 1954, 25 years after Black Tuesday. For an investor who had held shares through the crash and its aftermath, patiently waiting for the return that had been promised by the optimists of the late 1920s, the recovery arrived a quarter-century late. Many of those investors were dead by then. Others were old. The patience they had been advised to maintain had required more of them than they had understood when the advice was given. The generation that lived through the crash and the depression was changed by the experience in ways that shaped their behavior for the rest of their lives. They tended to save more than previous generations. They tended to distrust institutions that had proved untrustworthy. They tended to keep some portion of their assets in forms more concrete than paper, in property, in gold, in physical things that could not be erased by a stock market decline or a bank failure. The economists who would study this generation in later decades sometimes called it the Depression-era savings premium, the persistent tendency of those who had lived through financial catastrophe to hold more in reserve than purely rational economic models suggested they needed to. This caution faded, as cautions tend to do, as the generation that had acquired it was gradually replaced by generations that had not. By the 1980s, the regulatory framework constructed in the Depression years was beginning to be loosened. Not dramatically, not all at once, but steadily, in the manner of something that happens so gradually that it is difficult to identify the precise moment at which enough has changed to matter. The separation between commercial and investment banking, which Glass-Steagall had enforced for 50 years, was eroding through regulatory interpretation before it was eliminated by legislation. The culture of disclosure that the SEC had established was under sustained pressure from an industry that found compliance expensive and constraint uncomfortable. On October 19, 1987, Black Monday as it came to be known, the Dow Jones Industrial Average fell 22.6% in a single day, the largest single-day percentage decline in the index's history. The mechanisms were different from 1929, program trading, portfolio insurance, the globalization of financial markets, but the structural pattern was recognizable. Leverage, interconnection, the cascade of forced selling, the gap between what the system appeared capable of absorbing and what it was actually asked to absorb. The Federal Reserve this time responded rapidly and with sufficient force to prevent the 1987 crash from developing into a depression. The lesson of 1929 had been, at least partially, absorbed. In 2008, a financial crisis of a different character but a familiar shape engulfed the global economy. Mortgage-backed securities, collateralized debt obligations, credit default swaps. The specific instruments were unlike anything that had existed in 1929. The regulatory environment had been transformed by 7 decades of accumulated legislation. The global financial system was infinitely more complex and interconnected than it had been in the age of the ticker tape, and yet, the overvaluation built on borrowed money, the leverage embedded in structures whose true risk was opaque to the people holding them, the investment banks selling instruments to the public while simultaneously betting against them in their own proprietary accounts, the gap between the theoretical risk assigned to assets and the actual risk embedded in them. The cascade of forced selling as the markets declined generated margin calls that generated more selling that generated further declines. The patterns were not identical, but they were recognizable to anyone who had spent time in the company of the events of October 1929. What does this recurrence mean? Is it simply that human nature does not change, that the combination of greed and optimism and the difficulty of pricing risk accurately will always, eventually, produce bubbles and their inevitable deflations? Or is it something more structural, a quality inherent in financial markets themselves, in the way that the expectation of future gains feeds back into present prices in ways that can carry those prices beyond what the underlying reality supports? The honest answer is probably both. The financial economists who have spent careers studying the dynamics of asset prices have produced a substantial literature on the mechanics of bubbles, on the conditions that allow prices to deviate from fundamental value, on the role of leverage in amplifying those deviations, on the feedback mechanisms that can turn a correction into a crash. This literature is valuable, and it has produced genuine insights, but it has not produced a reliable method for identifying bubbles in real time, or for determining when the deviation from fundamental value has reached a point from which a sharp correction is inevitable rather than merely possible. The people who predicted the 1929 crash, Babson and others, were not operating from a more sophisticated economic model than the people who did not predict it. They were, in many cases, simply applying more conservative assumptions to the same data. The difference between them and Irving Fisher was not primarily a difference in analytical capability. It was a difference in the assumptions they brought to the data about what prices ought to be doing, and those assumptions were shaped in ways that are difficult to fully disentangle by temperament, by professional incentives, by the social environment in which they were working. There is a temptation, looking back at the events of 1929, to find them obvious in retrospect, to read the margin debt figures and the investment trust leverage and the divergence between stock prices and earnings, and conclude that anyone paying attention should have seen what was coming. This temptation should be resisted. The people who did not see what was coming were not, on the whole, stupid. They were operating within a set of assumptions that their environment had made seem reasonable, in a system that provided strong incentives to believe what was convenient to believe, and with analytical tools that were genuinely limited in their ability to price the kind of systemic risk that eventually swamped the market. The dust that settled on Black Tuesday remembered all of this. It settled on the trading floor of the exchange, on the brokerage offices of 1,000 American cities, on the modest ledgers of people who had believed in something and watched it evaporate. It settled on the careers of brilliant men who had been wrong in ways they did not fully understand, and on the savings of ordinary people who had trusted a system that had not been designed to protect them. And it settled too on the seeds of the reforms that followed. The slow, difficult, contested reconstruction of a financial system that had demonstrated with unambiguous clarity the cost of building cathedrals from paper. The market always opens again. That is its nature and its promise, and in the right circumstances its grace. But the memory of what markets can do, the memory encoded in legislation, in regulatory frameworks, in the cautious habits of a generation that lived through catastrophe, is part of what makes the opening, when it comes, something other than merely the beginning of another cycle of excess. There is something quietly remarkable about the way in which financial memory works, both at the individual level and at the level of institutions and cultures. The generation that lived through the Depression remembered what they had survived with a specificity and a permanence that shaped their financial behavior for the rest of their lives. But the generation that followed, who had read about the Depression in textbooks and heard about it from their parents, carried only the abstraction, the historical fact without the bodily knowledge, the lesson without the experience that made the lesson feel urgent. And the generation after that encountered the stories of 1929 primarily as historical curiosity. The crash, as a chapter in a textbook, as a setting for period films, as a backdrop for stories about people in old-fashioned clothes doing things that no longer seemed possible in the modern, regulated, FDIC-insured, SEC-supervised financial world. The Depression-era reforms had worked so well for so long that they had made the conditions that necessitated them difficult to imagine. This is the paradox at the heart of financial regulation. Effective regulation prevents the crises that would justify its existence, and in preventing those crises it creates the conditions under which its own rationale becomes difficult to perceive. The absence of catastrophe becomes evidence that the precautions against catastrophe are excessive, burdensome, an obstacle to the efficient functioning of the market. And so the precautions are gradually relaxed, the restrictions gradually loosened, the memory gradually replaced by a new round of optimism, until the next crisis arrives to begin the cycle again. The events of October 1929 remain, nearly a century later, the most consequential market crash in American history. Not because of their immediate financial magnitude. By certain measures, the 1987 crash was sharper and the 2008 crisis more globally systemic, but because of what they set in motion: the Depression, the New Deal, the reconstruction of the American regulatory state, the fundamental renegotiation of the relationship between government and the economy that has shaped American life ever since. The man in the boarding house on West 48th Street with his careful ledger and his silent telephone is part of that history too. Not as a famous figure, not as a decision-maker, not as someone whose name appears in the archives of the Pecora hearings or the pages of the financial press. He is part of it simply as someone who was there, who participated, who believed, who lost and who went on. That going on, the quiet, unglamorous, mostly undocumented act of continuing, is perhaps the most common story the crash produced and the one most deserving of acknowledgement. The market always opens again. That is its nature and its promise, and in the right circumstances, its grace. But the memory of what markets can do, the memory encoded in legislation, in regulatory frameworks, in the cautious habits of a generation that lived through catastrophe, is part of what makes the opening, when it comes, something other than merely the beginning of another cycle of excess. At least that is the hope. And hope in the long view of financial history is as recurring as the patterns it must perpetually contend with. The events described in this script are drawn from historical record. The Wall Street crash of 1929 and its aftermath have been the subject of extensive scholarly research, including John Kenneth Galbraith's The Great Crash 1929, Milton Friedman and Anna Schwartz's A Monetary History of the United States, and Robert McIlvain's The Great Depression. The Pecora hearings transcripts are available through the US Senate archives. Figures cited for margin debt, trading volumes, and Dow Jones movements are drawn from contemporaneous records and subsequent historical analysis. The composite character of Clara Steinberg is not based on any specific individual, but reflects the documented experiences of ordinary investors in the period. And so, the story settles, the way stories do. Not into resolution exactly, but into a kind of quiet. The ticker tape has long since been replaced by screens. The floor of the New York Stock Exchange, which once held hundreds of shouting traders, is now largely ceremonial, its transactions processed by machines in data centers far from Broad Street. The physical architecture of the crisis, the brokerage offices, the margin accounts, the investment trusts, has been transformed beyond recognition, but the underlying dynamics are still recognizable if you look at them with the right kind of attention, the tension between optimism and reality. The way that rising prices attract new buyers, and new buyers push prices higher, and higher prices seem to justify the optimism that drove them. The difficulty of maintaining the conviction that a market is overvalued when the market continues to rise, and everyone around you is growing rich. The way that leverage transforms a manageable decline into a catastrophic one. These things persist, not because people are foolish or wicked, most of them are neither, but because the market is, at its core, a mechanism for aggregating human expectations about the future, and human expectations about the future are shaped by human psychology, which has not changed significantly since October 1929. The man on the edge of the narrow bed, in the boarding house on West 48th Street, with his careful ledger and his silent telephone. He is not a historical curiosity. He is a reminder of what markets can do, of what optimism costs when it outruns the evidence, of the gap that can open, without warning or visible seam, between what we believe we own and what we actually hold. Sleep well. The numbers will be there tomorrow, patient as always, waiting to be read. If you're still with us, thank you for travelling this long road through history. If this story gave you something, a new understanding, a quieter mind, an hour of company in the dark, please consider subscribing so the next chapter is waiting when you return. Sleep well. Sleep landing. The room is quiet now. The numbers have all been read. The hearings are over. The ticker tape has stopped. The men who built the cathedrals of the 1920s have grown old or passed from the record entirely. What remains is the story, and what the story holds, if you let it, is not anxiety but something closer to wonder. That human beings could build something so vast, so intricate, so dazzlingly complex, that they could believe in it so completely, that they could lose it so quickly and begin in the wreckage to build again. Let the story carry you now. Let the voices of 1929 recede, the shouting on the trading floor, the ringing telephones, the long silence after the ticker stops. Let the room be cool and still. Let your breath slow to the rhythm that your body knows without being told. The market always opens again. But for now, it is closed. For now, there is only the quiet. Rest. If you liked this video, let me know where in the world you're watching from and what time it is. I'm always curious about that. And if you have a suggested topic, feel free to leave it in the comments.